Can't believe. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, U.S. banks face a new solvency risk as this surges. And what I want you to understand that the central elites cannot see what's going on in the banking system. And yet what is going on right now, as we see the data surging here, it's threatening to kick off a cascading wave of bank failures and send us right into the next financial crisis. Now, let's head over to Bloomberg where he picked today's story up, and I want to set this up by just showing you just how clueless these central elites are as they can't even see what's going on in the banking system that they allegedly regulate. And here we have the headline is Fed's Waller urges patience on rate cuts after a jump in prices. He says the strength of the economy and the recent data we have received on inflation means it's appropriate to be patient, careful, methodical, deliberative. Pick your favorite cinnamon, and whatever word you pick, they all translate to one idea. Well, what's the rush? Well, Waller, I'll give you something to be in a rush about. The banking system that you regulate right now is facing an existential crisis and is about to send a lot of banks into insolvency. And all we're going to look back and say is, why didn't you see this coming? His comments were built on similar messages from other Fed policymakers. We'll take a look at them here in a moment, because Waller goes on to say that he needs to see a couple more months of inflation data to be sure that January was just a fluke and they were still on track to price stability. Well, we know we're on that track because when central elites invert yield curve and money curves, they constrict the creation of credit in a debt-based economy. And if there's not enough money to go and meet demand, well, then demand comes down, supply goes up, and sure enough, over time, it's not instantaneous that what you see is disinflationary effects and sometimes outright deflation take grip over the economy. His conjecture in the absence of a major economic shock, well, that's coming in the banks, as you'll see soon enough. Delaying rate cuts by a few months should not have a substantial impact on the real economy in the near term. That is, if consumers wish their banks to remain in solvency and stay open. Well, if this continues, what we're seeing right now, well, we're going to have a much bigger crisis than even the Fed is prepared to manage. And I think we have shown that acting too soon could squander our progress in inflation and risk considerable harm to the economy, even though there's absolutely no evidence to suggest that that's true. Let's take a further look and see what other Fed members are saying as we see top Fed officials bolster case for patient stance on rate cuts, and at some point we gain greater confidence that disinflation is ongoing and sustainable. The changing outlook will warrant a change in policy rate. Of course, it's obvious here that we can see that Cook can't tell that we're seeing demand come down. We can see it in the factory sector. We can see it all over the place. We see it in retail sales. We're hearing all this evidence that demand's coming down. The problem is they wanted to get down to their 2% target very quickly so they can proclaim victory. And that's just not how the data works. The problem is it's getting even worse. But something that should give you great confidence, that's your ability to trade. And this week, we've done something for our subscribers. I put out videos every day to help you with the trades, because our new reports are even better than before, because we give you the signals when they happen. On page 1, it tells you every day when we see a key signal. Let's update you on one that's just doing extremely well. This is FXI, the China large cap ETF, back on January 25th. Our momentum timer pro. This looks at all those technical signals like the RSI, the MACD, and even one of our own proprietary signals that we built into the report to give you an edge. It said, this is the time. We're under a big short position here. It's reversing. That's what we wanted to see from a technical basis. The momentum has shifted. And then we see on our CTA timer pro report, again, we do the same thing on it. Many of you said, can you just show me the signals that are flipping, because I don't have time to go through your report every day? You got it. On page 1, we show you when they come off these deep short positions. And sure enough, on January 26th, it happened. On that Sunday, we showed you on our chart show to take a trade. That trade now is up 6.78%. If you would have followed our advice, sure, it would have gone down a little bit. That happens when you trade, but it's taking off and looking to go a lot higher. Right now, there are 3 coupon codes for a free month in the description below for each report. Grab it and get on those videos. We're going to show you how to trade and be successful, because one place is not seeing success. Well, at least it's the Fed. For a moment, they can proclaim victory, but that victory is soon going to turn into defeat, because they claim they care about consumer prices when really the Federal Reserve is a domestic banking regulator. If there's anything they should care about, it's the health of their banks. And I'm going to show you what's going on here, because it's serious and it tells you there's something fundamentally wrong with the economy, and our least of our concerns right now should be inflation. But the notion that Fed even cares much about inflation, well, sometimes you can see the federal funds rate here against the consumer price index in blue. Sometimes they cut after inflation goes down sufficiently. Sometimes they start cutting before. In fact, there's no rhyme or reason why the Fed does what they do at all, other than the fact that they just decide what they want and stick with it. Yet again, we continue to see that they just don't understand what's going on in the system. As Jefferson agreed, rate cuts this year are likely, but Senate officials need to be on guard against reducing them too much in response to easing price pressures. He goes on to say excessive easing can lead to a stalling or reversal in progress in restoring price stability, and yet we have virtually no evidence that that's true. Absolutely none. The only evidence we could look back to is the 1970s, and that, of course, we were not a global synchronized economy. We weren't really much of a global economy at that stage at all. The dollar was just figuring out its path as the world's reserve currency. So we did see some other effects, particularly in the energy sector, that caused a resurgence in inflation. None of that we're seeing today. But yet they look at their models. They don't look at the real world here and understand we're not going to see that happen at all. In fact, what we're going to see is a whole lot of banks fail. And I believe we may be in the position to see rate decrease this year, according to Harker, who doesn't vote on policy decisions. But I would caution anyone from looking for it right now and right away. So you get the distinct impression from all these members of the Federal Open Market Committee, whether they're voting members or not, that they believe that rates need to stay elevated for longer. And what this is doing is inverting the yield curves. And this is causing short-term rates to go higher than long-term rates. And the longer we do this, the less money that's created by the commercial banks in the system. And because debt is a priority in a debt-based system, money has to go to pay to debts. Now, the key is when you make a payment on a loan from a commercial bank, and the principal value, whether you're paying the whole thing off or you're making a monthly payment, that money is destroyed from the system. You do this long enough, and what happens is you find out there isn't enough money to support the economy and asset prices and pay on all the debt. And the one place we know the evidence has valued this is the yield curve itself is convinced that the Fed, shown in red, you see the funds rate, is going to come down in a massive way, because this is the second largest and longest inversion since the 1980s, when the Fed went on a multi-year cutting spree, and we're going to see them back at zero. We're at zero, not just once, but twice. There will be a third time, because now we can see U.S. commercial foreclosures are increasing in January of 2024. This is something that I can't believe how bad the numbers are. Now, I knew they were going to go up, but this is terrible. And so I want you to be thinking as these numbers go higher and higher. And why is that happening? There just isn't enough money and demand in the system to support the asset prices behind these buildings. So what's going to happen is those who own it are going to foreclose on them and just send the keys back to the banks. The banks are now going to be sitting on these loans and faced to write them down. The problem is these small and mid-sized regional banks that carry a lion's share of a commercial real estate loans do not have the margin to eat the losses on these buildings, because the problem is they're already insolvent. It's coming next month. They've got to start paying back those bank term funding program loans. How they're going to do it? Nobody knows. Because here we can see Adam, a leading curator of land, property, and real estate data, released a special report on commercial foreclosures. The report reveals a significant climb in commercial foreclosures over the years, from a low of 141 back in May of 2020. Of course, we had a lot of stimulus and government bailouts, to now 635 as of January 2024. And you can see in this chart, it represents a steady increase throughout the period, on our way back as we look forward to the highs set back, at least since they started recording data in 2014. And we can note that this is exactly what happens when the Fed tends to raise rates. They invert the money curves. And here you can see the federal funds rate still in red, but now we've got the delinquency rate on commercial real estate loans in blue. And sure enough, after the Fed raises rates and they kind of constrict the creation of credit, with a lag, you see delinquency rates go up. Well, those eventually turn into foreclosures. You see that effect, and now it's happening again as the delinquency rate surges. And that's why I wanted to start the show out by saying that the central bankers here, they don't even see what's going on inside the system that they allegedly regulate, because they're too fixated on inflation, which is a guide they never followed to begin with. It's absolutely ridiculous, because what this is going to do is set off a chain reaction of bank failures. We already know what the Fed's going to do. They're going to merge banks together. The problem is there's going to be a lot of banks that are going to need someone to merge with. Because here we can see that by January 2024, commercial foreclosures had surged to 635. That is a 97% year-over-year increase, which signals a revitalizing market that is navigating through the long-term economic shifts. I like how they're spinning this. Following a global event, adapting with resilience and strategic adjustments to new commercial realities, or the fact that there just isn't enough money in the system or demand for buildings, because we have this big work from home movement, we have empty buildings, we have a slowing economy. We need the value of these buildings to be written down. Of course, those who own them don't want to do it. It's easier for them just to let the loan go into foreclosure and put it back on the bank balance sheets. And we know they just don't have the money to absorb this at all, and that's going to lead to even further declines in prices, as this uptick signifies not just a return to pre-pandemic activity levels, but also underscores the ongoing adjustments within the commercial real estate sector. I like that. Ongoing adjustments on the way down as it navigates through a landscape transformed by evolving business practices and consumer behaviors. This from the CEO, Rob Barber at Adam. Or we could just say that people don't need these big buildings like they used to anymore. There just isn't a demand. And if you want to make the case of why I've said that during the next recession, there's going to be a massive push to send all these work from home people back to the buildings that they used to work in, and you're going to watch, the government will put some incentives out to do it, because when you find out that a lot of municipalities generate tax revenue based on the value of these buildings and they get cut in half or more, well, there's going to be blood in the streets, my friend, and things are going to change in a big way. But we knew this was going to happen. We just didn't know how bad it was going to get this quickly, because when we look at the net percentage of banks, domestic banks tightening standards for commercial and industrial loans to firms of all sizes, what that means is when they tighten lending standards, it's real simple. They just don't want to lend. So you go to the bank, you try to borrow money, and they have some reason why that you can't get the money you want, or the terms are just so outlandish you don't want to do it. That is the beginning of the constriction of credit in a debt-based economy. And lo and behold, now we don't have the foreclosure rates in the Fed database. They're not available, but they do have the delinquency rate on all loans. And here you can see in red, those tend to follow with a lag as banks tighten lending standards. So we know the next time this data series is updated, it's going to head a lot higher, and there's going to be no stopping it, because according to the Fed, as of right now, there's no reason to cut rates, no time soon. But yet, if we look over to China, we'll give you all the reasons we need to cut, and in a big way. As China's property foreclosures surge as growth slows, that sounds exactly like a headline we'll see here in the U.S. as new listings of foreclosed properties nationwide rose 48% in January from a year earlier, compared with 37% in 2023. Now, keep in mind, we're just talking about commercial properties here. We haven't even gotten to the fact that wait till this hits the residential real estate market here in the U.S. It's just a matter of time. Now, we know the housing market does remain strong here, but that is, again, the question is for how much longer. And here we can see the over 100,000 properties listed for sale last month include residential, commercial, and industrial transactions in January rose about 18% year on year, because China's economic downturn has resulted in a growing number of debt-saddled property owners who are forced to sell, especially as real estate loans account for a large majority of the country's non-performing debt. Now, you might wonder, well, that's not going to happen here. There's such a demand for housing in the U.S. This can't happen. Think about this. When people lose their job and get on unemployment and stay there for a long time and have their bills continue to rack up. They can't access more money through their credit cards and no more buy now, pay later loans because they've tapped it all out. They're going to be looking to sell their homes, and then if prices start to come down, there's going to be, again, a race to unload them as quickly as possible to get whatever equity you can. It's all a matter of when the tide turns. You can see what's happening in China, and you can tell it's going to get here at some point because China home prices are now falling at a slower pace as support mounts. What it should say is Beijing runs to the rescue to do whatever it can to keep its economy from crumbling into abyss and taking the world down with it. Maybe this is just a case where China wants to let Germany be the lead. We'll see, because new home prices in 70 cities, including state-subsidized housing, dropped 0.37% last month from December, and when they retreated, 0.45. Now, that isn't a big number, but price declines continue to narrow, which is giving policy makers some hope. The problem is consumers don't want to see property values go down, particularly when they're loaded up on debt. This just doesn't inspire confidence at all. In fact, the slide in home prices may have passed its worst period. At least that's the hope, as policymakers have increased pressure on banks to boost their property loans through so-called whitelists. In a flurry of activity, state-owned lenders have earmarked at least 124 billion yuan of loans for property works eligible for support. This, according to state media. The only question is there enough demand from consumers to come out and buy it? Just because you build it doesn't mean there are people that will buy it. We know that for a fact, and all this is going to do is end up leading to the Fed cutting rates. And as you can see, the PBOC, here they go, time to cut. As China's central bank tries to catch markets off guard with surprise easing, as the moves reflect the PBOC's efforts to step up support without abandoning its restrained approach to stimulus, the central bank's scope for action remains restricted by the risk that bolder approach would weaken the currency. Of course, that is the fear of central bankers, as they actually have control of the currency, which we know they don't. Of course, this will be the case where the Fed will have margin to cut due to the relative strength of the dollar against other currencies, and then other countries will cut again and spur another buildup in debt and burn through policy room that'll be needed later on if the longest streak of deflation, I like this, that'll be needed later if, keyword if, the longest streak of deflation since the 1990s and prolonged property downturn worsens. We know already that is the base case here. The only question is, how bad does it get? Because we already know the U.S. banks, the small and mid-sized regional banks, are insolvent. They borrowed a massive amount of money from the Fed and everyone else they could get it from. Those loans are going to start coming due in March. The only question now is, as we see their loan book contract, which is bad news, and we see an increase in foreclosures, it's just a matter before the U.S. banking system is facing a massive amount of failures and an all-out crisis. With that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.